I think what happened in 2020 is that the market was pricing in all of this free ride and all of the stimulus, the fiscal and the monetary policies, and it priced them to where there was no reason for gold to continue to go up above where it was. So it reached its all-time high. It became apparent that you cannot continue to stimulate the economy in the same fashion, and therefore the risk reward changed altogether. Once that happens, speculators, traders of gold, they can start speculating on how much downside it has. But you can never know. Is it 10%? Is it 15%? Is it 20%? The one thing they do know is that it has more downside than upside. So when the market starts to get to that point where it says, look, the upside here is very limited, the downside here is going to be amazing once Powell just says, hey, we need to start trimming this thing, trimming the stimulus down, or when a vaccine was introduced, because that obviously offered a lot of assurances that we don't need to keep supporting this income gap that was created because of all the unemployment. And so on that date, on 6th of August, 2020, the market basically collectively reached that point where it was the top. You never know that in advance. You had a lot of reasons to think, because July was the best month for silver since 1980. You had all of the signs that, man, this is reaching euphoric points, and on that date, that's what happened. So you reached that all-time high, and then you started to go to the other side. Bond yields started to go up in anticipation of slowing down, of tapering, of vaccines, of back then of Biden winning the elections and not Trump, and the momentum shifted. When it shifted, it started to shift real hard to where we overstimulated. I think we've over-exaggerated, the central bankers and governments over-exaggerated, and now I think we will have an inflationary problem. And that actually played a negative role on gold for 2021, because if you believe that a tapering is coming and that this is detrimental for gold, and now you think that inflation is a bigger issue than meets the eye, and that it's not transitory, then this is going to be an aggressive tapering, and gold needs to find that spot where the market is priced in the worst type of tapering. That is the bottom. And when that happens, then if the Fed says, look, we're going to raise rates, that's fine, because it's already baked into the current price. You never know these things with any commodity, because it depends on millions of buyers and sellers just reaching that point. What you do know is just likelihoods and probabilities. And we're still, in all likelihood, have not seen the bottom for gold, because you just don't know what the next inflation print will do, or what the next job report will do. If the job report comes in real hot, then the Fed needs to react to that. If inflation comes real hot, then the Fed needs to tweak to that. The best time to know that gold has bottomed finally is when they actually say we're raising rates, because from that point on, there's a lot of assurances on what can happen, right? They're going to probably raise rates to about 1%, right? From 0 to about 1 or 1.25. So if you can start to know the future with that amount of certainty, like I'm going to have about 4 to 5 rate hikes in this cycle, and then that's it. It's over. They're going to start tapering down. Then you can start pricing in what is the price of gold really worth. Because if it's only 1% that we have of raising rates, then if inflation remains about 2.5%, 3%, or even more, then we're still in a negative rates environment. And in 12 to 18 months, we're going to have rate cuts again. So then the price of gold reacts to that, to the upside. I think you're in a place where the downside is limited right now, because we're almost at that point where it's almost a sure thing that in June 2022 they're going to start raising rates. But even if they don't, it's going to be July or August. The structure is there. Mm-hmm. And so I think for a long-term holder, most of the decline is out of the way. And if you don't have exposure to gold, you can start building that position. If you're a trader, I think that you can build up your cash position and wait a little bit more, because I think it will get far more exciting in 2022 once we see that the taper is coming to a close and that the Fed is starting to signal that they're going to raise rates. I think that's when gold will start to explode. So if you're asking me why are higher rates not negative for gold, the reason is that higher rates are already priced in to a large degree. And secondly, that the market doesn't believe the Fed when the Fed says that it is in front of the curve. The market seems to think that the Fed doesn't understand the severity of inflation, and therefore it believes that if inflation numbers keep being hot, that the Fed is going to be surprised. And so there's more of a potentiality of this being more aggressive. Once the market becomes convinced that Jerome Powell says the right words, where the market understands that the Fed is not behind the curve, that it has inflation under control, I think that is also great for gold. It's counterintuitive because people think, well, if inflation is out of control, it's great for gold. Not the case, because that means that you're going to have more rate hikes, and that is not priced in. So I think in general, inflation being under control is good for gold. Raising rates in a moderate way is good for gold. The last 6 rate hikes during this 50-year period of fiat monetary policy, once the Fed says we're raising rates, gold has on average rallied by 30%. 1972, 1974, 1979, in the 90s, in 2004, and in 2016, the last time we had a rate hike. So rate hikes are great for gold because the market prices in everything before that.